All right, welcome back to the Economics of Real Estate. I'm Dylan Silbernagel. This is my partner, Matthew Gizzie. This is where we take a deep dive into the GTA housing market, sharing our insights for what we saw last month, as well as giving you a snapshot of what's currently going on and some of the policies and outside influences that are impacting our housing market. Matt, how are you doing today?
I'm doing good today. Maybe a little bit better than Mark Carney. He's sitting beside Donald Trump down in the Oval Office today, and some probably going to have some very tough conversations with the Donald. But hopefully the two of them can figure something out, and we can get things back to rolling between our two countries again.
I like it. I like it. Yeah, I wouldn't want to be in that meeting myself, to be honest. It doesn't sound like a good
No,
time. I
no.
think what all of us are looking for here in Ontario and the GTA in particular, when it comes down to housing, is we've got a challenge with uncertainty, particularly with what's going on south of the border. We're wondering about our economy, where our government's going to start moving their policies. Because as you and I have been watching, in comparison to last year, our interest rates have come down, so affordability and pricing has come down in a lot of places. So affordability is actually easier, a little bit better, but our sales volume is much worse. We're moving a lot less homes. It's taking longer for homes to sell, and they're actually cheaper than they were last year. So we know there's an uncertainty issue that's going on. Plus, as you and I have spoke about a number of times, kind of that lagging impact from higher interest rates as now more people, as those renewals kept coming down the pipe, are now being actually impacted by it. Because in the first, though the run up was big in terms of interest rates, people that are now looking to purchase or now looking to make that move, they're the ones that are going to realize the impact of these still higher rates, even though they've come down from where they were last year.
Yeah, I think a lot of individuals that refinance at the cheaper rates probably started at the end of 2020. So we are in the beginning of 2025. So as we kind of get to the last 6 months of this year, we're going to notice a little bit more individuals that had locked in at super low rates that are going to start refinancing, and that's going to go into 2026 as well.
Yeah, yeah, definitely. I mean, all the way through really till March of 2022 is when we first started to see those rates really start creeping up. So, we've got till 2027. Really, well, people will still be impacted by this. All right, for our show today, funny enough, interest rates still a topic, not the only topic, but we want to make sure that you guys are understanding where affordability comes in. And this is a conversation not just for our agents, but also for our homeowners, our buyers and sellers out there when they're looking to make those purchases. Now, it's funny enough, Matt, we have the pleasure of speaking to a lot of agents in our world. And it's funny when I have these conversations, the amount of agents that say, you know what, not once have my clients that are buying and selling actually really brought up the interest rates. Like they want to know about them in terms of what it's going to cost for their purchase, but it's not the reason they're moving or not moving, right? And we've learned and we know that real estate and life in general doesn't care what's happening in the market, doesn't care what's going on in the economy. People have to move regardless. People want to move regardless and aren't impacted by some of these things. So it is interesting to note that a lot of people out there that are buying or selling, that is not the reason that they're doing it, right? It may not even come up in conversation other than how much can I borrow based at these new rates? How much is it going to impact me? We're also going to talk about 2021 to 2025 pricing. We're going to talk about some rate predictions, business confidence, the new liberal housing plan now that they've won and they'll be implementing some of this stuff, first time home buyer package, as well as we break into all the municipal and regional markets. And I want to give a quick shout out here to Michelle. Michelle, thank you so much. Good afternoon to you as well. Hope you enjoy the show. We've got lots of stuff. For those of you that are watching, please let us know what areas you are particularly focusing on, and we will make sure, obviously, that we cover them today. And if we don't have slides for them, that we'll cover them for you next time. All right, Matt, let me jump into it here. Talk to me about where we're at in interest rates and particularly why we're highlighting here back in September.
Yeah, I mean, at the end of the day, when we're looking at the Bank of Canada overnight lending rate, it's at 2.75. When we go back in history, it's still as high as it was since September of '08, uh,
Yeah.
right around when the great financial crisis was happening in the US. So we're still extremely elevated when it comes to variable rates as to where they've been basically since the great financial crisis even happened. You can see just how aggressive the central banks had to get when they cut interest rates. So we're still a ways to go even before we get to where we saw interest rates on the variable side, or at least from the Bank of Canada's side, that we saw in 2018 and 2019 when the market was still a little bit soft as well.
Yeah, and I mean, if you take a look at it, we're following almost a similar pattern that you were seeing there after the '08 and the financial crisis there. But I think this is just a good reminder for realtors as we're out there and you start hearing predictions. I mean, even coming through the fall, there was people out there saying like, "Watch what's going to happen in the spring. The market's going to take off. It's going to take off." But look at where those rates were, even all through the 2010s, leading into 2020, in comparison to where we're at now when we're talking about specifically the Bank of Canada rate. So, it is important to note. I'd like to think that we're following this similar trend line down now as we currently sit. And you can see those, even we're at a little shorter of a hold there at the 3%, how quickly we made that next cut. And talk to me here about bond yields that we know impact more of our fixed rate financing in comparison to our variable rate financing that we see from the Bank of Canada.
Yeah, so even bonds, even the bond side, which, like you said, dictates more of the fixed rate side. We're still as high as we've been since May of 2010. So we're still 15 years. It's been 15 years since we've seen, we've stayed at these types of levels. Sure, we saw it back in 2023 when the markets were shifting, but we're still there. And you can see just the acceleration to the upside that we saw on the bond side. And after this, I've got some more charts to kind of show where in the market these changes happened and what they've kind of done for the price. So yeah, if we go to the next chart here, we can see the first blue line is the Bank of Canada interest rate. So this is the variable rate. This is when it was at its absolute lowest. Now bond yields ended up moving before that. So when the market peaked out in 2021, people were rushing into variable rate mortgages because they were still extremely cheap. So we can see once that blue line represents where the interest rate started to go up. And I've drawn a straight line through for where prices were back in the beginning of 2021 until now. And other than the peak, prices have held up quite well. It's come to test the line basically in the spring markets over the last 2 years. This year is struggling to get up there. And it could be one of those situations like we've talked about before where it could take a little bit of time to get up there later in the year. And then the other line is the red line is the 5-year bond yield. Like this is when it peaked out, absolute peak, and now it started to roll over. And the bigger blue line is the variable rates peak that have started to roll over. So we're seeing interest rates come down on both ends, the Bank of Canada and the bond, but prices are still very sticky. I think it's a good sign that they're holding up since 2021. But even with the cheaper rates, we're not getting that bigger uptick in the price.
Yeah, I saw an interesting post today talking about, a 16% drop. You and I, when we were looking at numbers before, it was closer to 19 and a half down from the peak. But what's important to note, and I love that you highlighted this here from the start of 2021, when you started drawing your line, it's just this short window here that was really the peak. So again, it does impact buyers of that time and homeowners of that time. But in the grand scheme of the hundreds of thousands of transactions that have taken place over the last couple of years, it really is just this window. And like you said, the rest of it has been fairly sticky in terms of those ups and downs, where we're not seeing that big drop off from the peak, where it was really just that window in terms of the amount of people that were affected.
And one thing too, if you look at where prices were at the beginning of 2020, they're significantly lower. So even though those people are refinancing coming to the end of the year, there should be a little bit of room for them. And it might not be as impactful as before.
Yeah, it'd be nice to see the banks, and depending on where we're at, that our rates really do continue to come down for when this cohort comes through. Like we said, it is a smaller percentage, so I don't think that they will be as concerned about it to make major policy decisions on that. But nonetheless, it'd be great to see that for the people at that who took on probably the most amount of debt at the lowest interest rate, when their renewals come up, that's where we're going to feel some of the pain.
Yeah.
And so again, yeah, now moving from all of Treb coming through and taking a look at York in terms of those same peaks. And again, you see that stickiness and even the increases that we saw there for a little bit across 2024, and specifically at the beginning of 2024, right? That's where we saw the market was quite hot there for a little bit, probably starting to taper off a little bit around March, but nonetheless, looking at that median sale price, it's not bad.
It's not bad. And so, there's a lot of news out there that things are pretty bad. Prices are dropping, yada, yada, yada. But when you go back and you look, and let's just take out the peak in 2022, at the beginning of 2022, take that away, and it's just been a very stable market, even with rates going as high as they went.
Yeah. Yeah. Well said. Taking a look at Simcoe, our graph is articulating about the same thing. We see our peak. There's the correction there as the rates started to increase at the beginning of 2022. Clearly had the impact there on pricing. And then really Simcoe's fared well in terms of where we were at the start of 2021 in comparison to where we are now, where we're hovering a little bit more above that line specifically. Like it's outpacing what all of the Toronto board is showing, which is great for Simcoe.
Yeah, I think the reason I put the Toronto board at the beginning was to show, like, as a whole, there is some weakness as a whole. So there are areas within the Treb coverage that are doing far worse. But when we look at some of the areas that we focus on the most, York, Simcoe, and the GTA, very stable market right across the board.
Mm-hmm. I like that. And here we can see where the GTA, we dipped down a little bit coming through the end of 2024 and 2025, but are on the upward trend there in terms of our median price, which is nice to see in comparison to where these rates were. All right, Matt, this is one of my favorite slides because I love trying to figure out where these Bank of Canada rate announcements are going to come in and what we're going to expect to see. This is updated now as of April 30th. And correct me if I'm wrong, did we see the June date, the June cut that we thought was going to happen get pushed into July, or is this where we were before?
Yeah. Well, June's 50-50 now, so it's a bit of a toss-up. We still need more data to come in. Mark Carney has just taken over officially as the prime minister, and there's a lot of work that needs to be done because he doesn't have a majority government. So I think as of right now, we're going to call it a 50-50. It's probably best to see, if he finds a dance partner to get some of his policies passed, and that number could definitely start to change. But as of now, definitely for July, the market is pricing in a 92% chance of a 25 basis point cut.
Yeah. And by the end of the year, 97% chance that we're hovering, that we just get those two cuts, where previously I think we were looking at three cuts was the prediction. And so they've pulled that back a little bit now. Still 76% chance we're getting to 225, which is nice for those variable mortgage holders. And for what we know rates can do for the housing market. So not bad. And then now, interesting, looking at the fixed rates, again, this is the source of data from this is from Wawa, and it's going across the average of 10 lenders. So it does skew the numbers a little bit, but we're seeing increases here in those fixed rates that we hadn't seen, again, even averaging across 10 lenders. So that little bit of bump there from the bond market.
Yeah, and that's what we're seeing from the bond market slide. We did start to see bonds start to push to the upside. Yeah. That's mainly because there is a little bit of fear that tariffs are going to cause a little bit of inflation. So that's kind of what we're seeing in the bond market. That's what the bond market's pricing in a little bit.
Makes sense. And the bond market, obviously kind of transacting fluidly in comparison to when Bank of Canada makes their announcements. It's a great indicator to be watching to see where let's call it the smart money thinks things are going to go.
Yeah.
All right. Talk to me here about Urban Nation and the increase in rental supply. We've talked about this before through the lens of immigration, because we have a lot of our NPRs now leaving the country more so than before. We've also talked about it through the lens of we've got a lot more rental supply, like purpose-built rental supply coming to the market. So talk to me a little bit about the slide that we've got here and where you think rental prices and supply is going to be going.
Well, when we looked at new housing starts, 51% of all new housing starts was purpose-built rentals. And we haven't seen numbers like that in an extremely long time. And now we're transitioning into a part where exactly what you said, we're getting less individuals coming to the country for students and for temporary workers. So we're starting to see a little bit of a free up when it comes to the amount of rentals on the property. And we can see if we go back to March 2023 on the bottom left chart, we're seeing the downturn in rents in Vancouver, Toronto, Ottawa, where I invest. It's held up quite well, if not accelerating to the upside. And that's because
Mhm.
the liberal governments love to hire people. And we've got another 4 years of the Liberals, so there should be plenty of hires out in Ottawa. Montreal rolling over, Calgary rolling over, Edmonton holding up quite strong as well.
Yeah.
I think because of the oil fields and the oil market, a lot of jobs up there. And I think there's a lot of people that are leaving Ontario and some of the other provinces, and they're heading to Alberta, just because A, the cost of living is a lot better, and B, the being able to get a job out there for most people is more attainable there than it is definitely in Ontario.
Interesting. And then when we look at average asking price for rent dating back to what we got here, March 2020, you can see that little bit of the dip through our COVID months, and then really trending back upward. And now we've started to see, like you mentioned, through the fall, as we saw a lot of that supply start hitting the market, we see those average asking prices for rentals start to come down. A little bit of an uptick here currently. I'm curious to know what you think about that. Anything in particular why you think we're seeing this uptick?
Well, I think it's seasonal. I think people don't really want to go shopping for a place to rent during February and January, February, and March with all the snow. So I think we're starting to get better weather, and that's likely why we saw a little bit of an uptick there. So it'll be interesting to see if that continues over the next couple months. But we've got a ton of condos that are on the market that are being completed, and we have a ton of purpose-built rentals that are just flooding the market at the exact same time. So there's definitely a lot of pressure for rental prices right now.
Even with that, taking a look here at annual change in terms of asking rent, you can see that we're currently down 2.8% in comparison to last year, and even more so back in January.
Yeah, and that was a significant run in 2021, 2022. Just the amount of increases almost on a monthly basis of 5 to 10% increases in the rent prices was it was crazy, to be honest with you.
Yeah, yeah. When you think about the competition that we saw in the resale side of things, that trickled into the rental side of the market as well.
Yeah.
And the amount of applications you would have coming forward on your rental properties, sometimes being 21 to 25 different rental applications in the span of just a couple of days, because there was that
Yeah.
much demand for the rental units, is why we saw the pricing go up so much. Now let's pivot here, Matt, to new condo sales. We know that new home construction, like the starts, are really slowing down. And the reason for the starts slowing down is because we're having a challenge in the sale side of things. And this graph really articulates just how much those new condo sales has totally dropped off. And it's something that I think the GTA and Toronto in general is going to take a little while to recover from. We've got that challenge of homes not appraising, particularly in the new construction stuff, where you buy at a little bit of a premium, knowing that in 4 years, kind of speculating that in 4 years, when you take occupancy, that the value will have gone up. And as we came through a massive interest rate hiking cycle and we saw the correction, what that did to prices, people are having a hard time closing on those new construction condos.
Yeah, there's a lot of properties on the market for sale, off the market for sale. You know, this is an incredible chart to look at, going back all the way to 92, 95 for this level of new sales on condos. And I can assure you the amount of new condos hitting the market compared to 92 and 95 is significantly higher. And this is going to be an issue later in this year. I don't think there's any way around it. Um, I think on the family side, if it's large enough, it's going to hold up okay. But they built a lot of very tiny condos
Yeah.
that I think are going to
Yep.
really struggle and are going to put a lot of people underwater. And that will affect the market to a degree, because a lot of these properties are investment properties, and a lot of mom and pop investors are going to lose a lot of money on them.
Yeah. When you think about the demand that we saw that trickle into what we were building, right? We had so much immigration, we had so much student immigration
Yeah,
coming to the GTA, coming to Toronto specifically, and we had a big uptick in people that were jumping into the market, especially with those low interest rates. And so the product that we were building, that builders were putting out there, was almost targeted more towards the investor and the student and like the rental market, right? And families
yeah,
just don't want to buy these 500 to 600 square foot units that there's just a ton of. And to be honest, when you get down to certain developments down there, you see that very poor craftsmanship in some of them as well, notoriously in a couple of cases. So yeah,
yeah,
the end user, the family, does not want to buy those type of units, and we're just seeing that stuff sit and pile up.
yeah.
And as we broke it
But
down in one of our other videos, we're seeing some of those 2 and 3 bedrooms that were built still with great square footage in mind actually selling quite well in comparison.
now, to be fair, the Canadian government changed how they approach bringing new Canadians to the country. Instead of the past where you're bringing in more of a mature 20-year-old, early 30-year-old, and trying to get them into a specific job in the country, they've decided that they're going to go through the school route instead. They'd rather bring people into classes and courses where they know jobs are going to need to be filled in the future. So bringing them in through the school system and then putting them right to work after school, and that's kind of guaranteeing people their citizenship. Now, how it played out with a lot of those college mills
The
and a
institutions,
lot of
yeah.
people being told there is no jobs for them. I think there was some stuff that was corrupted by certain individuals on that side.
Mm-hmm.
But Canada had shifted; their policies had changed of how they were going to bring people in. So I think that's why we had such a craze when it came to these small condos, because they saw the shift. It wasn't families coming mostly now; it was more younger people.
Yeah.
But we'll see if those policies change as well. It's what's always important to when the government comes out with a budget or tabling any plans, especially if you're a real estate investor. It's how is this going to potentially affect the market that I'm in?
Yeah. And it's interesting because sometimes it's not immediately um I guess determinable what that impact is going to be, because then you started seeing these, like you said, the college mills start popping up and really inflating those numbers in terms of the amount of students coming here. And then what happens is the developers see that side, like you said, hey, we need to build for this type of client that we now have coming through, and then here we are 10 years later.
Yeah, and you know what? I've seen a lot of people trying to rent properties of mine. They've come through and they've said, you know what? I went to a school for 3 months and now I'm out working, and they found ways around the loopholes. And unfortunately, there was loopholes, and a lot of people came saying they were going to school and actually didn't go to school, and then were going right into the workforce or working under the table, and that ballooned the numbers of people we had too that weren't really counted for.
Yeah. Yeah. And I think that would have been interesting to see if the numbers were reflected in terms of that workforce. Like our GDP has been absolutely horrendous over the last 10 years. And when you hear people coming, like the amount of immigration that's coming, I think the idea from the government there was that was going to be a almost kind of a makeshift way to prop up our GDP, but we've had quite the opposite impact. So
Yeah.
all right, talk to me here about what it means for our small business barometer in terms of like that confidence index. And
Well,
I like to see that we bottomed out and
yeah.
we're coming back up. A lot of this is obviously impacted because of the tariff discussion. Has got to be the biggest impact here in terms of small business wondering how this is going to impact them, not knowing what their numbers are, where they're going to be importing from, how much it's going to cost them. But talk to me about this chart as we go through a few of these that we've got lined up for people.
Yeah, I mean, we were down to 25.5, and um, I think coming up to 34.8, some of it might be to do with now that they know who's going to lead the country, what party's going to lead the country, what the policies are from that government. Um, so there is a little bit more confidence coming there. I think also Donald Trump has kind of shown his hand a couple times, whereas a lot of this tariff talk and putting tariffs on hold or just keeping them at 10%. He just wants to make a deal. He's going to say that it was a fantastic deal for the United States, and then they're going to go on to something new. And I think people are starting to sniff that out a bit. It's not to say that there's not going to be long-standing tariffs, but I think small businesses are starting to feel a little bit more confident that some deals are going to get done probably sooner than later.
Yeah, fair to say. Now, when we're looking at staffing plans, this is something where it's going to directly come into correlation with employment, right? As people are wondering, where does that sit? And so, talk to me here as we've kind of moved, and as you've seen, you can see we've bounced back up in a couple of places in terms of that confidence, in terms of what these businesses' staffing plans are going to be.
Yeah, it's rolled over a little bit, but at the end of the day, you want your blue line to be above your yellow line. If we look at the down on the bottom right, we can see that it's still significantly elevated from 2024 and also between 2015 and 2019. We can see in the middle of the big chart between 2000 maybe 12 to about 2017. That's the kind of economy you want to see for businesses and for confidence with investors. Is that okay? Companies are hiring. It's an overall good economy. That gives a lot more investors, businesses confidence to start investing in their business. When the yellow line is elevated over the blue line, there's less confidence in the market. Businesses are going to be a little bit tighter on how they're going to spend their money, and that ultimately trickles into the economy with potential job losses, hirings, and money invested. Right?
Yeah, and so the blue line here for people that are watching is the percentage of businesses that are anticipating their staffing plans are going to go up. Blue is the percent. Oops, sorry. Blue is the percentage of businesses that are planning to go up in terms of their staffing plans. They're going to hire more people, and so the percentage of people, if we look over here on the right chart at the beginning of the year, percentage of those businesses that were thinking they were going to be laying people off or not increasing their staff was moving up at quite a drastic rate. And now, as of March, we're seeing that kind of taper back in as we have our April numbers. So, like
Yeah.
Matt was saying, it's still really high, the amount of businesses that think they're going to have to limit their full-time staff, but it is rolling over in terms of that number decreasing now. All right, future pricing versus wage increases. Matt, talk to me here about what this might mean for our
Yeah. I mean,
workforce.
we saw this is one of the 3.5 uptick was one of the most significant uptick we've seen since 2010, other than the pandemic, because of inflation. So this is why the bond yields are a little bit tight right now, because even businesses are potentially sniffing out that inflation is going to be a little bit on the higher side. Now that has rolled over a little bit. Like I said, I think that businesses are sniffing out that Donald Trump kind of played his hand. It might not be as bad as they thought. Inflation might not be as bad as they thought either. That's starting to roll over, and it's a good thing that we saw wage increases have fallen, but they're right at the historical average. They're kind of bouncing off the lower end. Actually, the historical average for wages is 1.9. So we are above the historical average for wages. So that's a great sign there. We just need the future prices to roll over as well. We want we want both of those to be very close together numbers,
Yeah.
so that people's cost of living isn't getting out of hand.
Yeah, and here you come after 2015, where we were in through 2016, 2017. They kind of come back together again, and then we saw that separation through the pandemic, but particularly as we saw inflation become a big issue. So our darker blue line here is what businesses think they're going to be charging the prices. Are their prices going to go up? Yes, they think so, especially after the start of this year with tariffs. Saw a massive jump. And then the future wage plans essentially, or the percentage of change in terms of wage increases, dropped, unfortunately. But like you said, we are starting to see a change. They are pointing back in the same direction now as we've finished up our election, and we'll see where that takes us. All right, Matt, I'm going to run through the housing plan here, and then what I'd like you to do is let me know what your take is on this thing and how you think it's going to impact Canadians. So, get the government back into the business of building. This is something that Mark Carney talked about as he was doing his election campaign. So the Liberal Housing Plan will create Build Canada Homes to get the federal government back into the business of home building by acting as a developer to build affordable housing at scale, including on public lands, catalyzing the housing industry by providing over 25 billion in financing to innovate prefabricated home builders in Canada, including those using Canadian technologies and resources like mass timber and softwood lumber, to build faster, smarter, more affordably, and more sustainably, providing 10 billion in low-cost financing and capital to affordable home builders. They're also going to talk about cutting the red tape. Part of this is cutting municipal development charges in half for multi-unit residential housing while working with provinces and territories to keep municipalities whole, reintroducing a tax incentive which originally introduced in the 1970s, spurred on tens of thousands of rental housing units across the country, facilitating the conversion of existing structures into affordable housing units, building on the success of the Housing Accelerator Fund, further reducing housing bureaucracy, zoning restrictions, and other red tape to have builders navigate one housing market instead of 13. So it's a lot of stuff, but essentially the government's getting back into the business of building houses and providing subsidies and financing for those that are going to help in that regard. What are your thoughts on all this when you ran through it?
Well, I'll be honest. I wasn't alive the last time the government was building homes for Canadians. That was after World War II. So there was a lot of men and women coming home overseas that needed jobs. That were, we had the baby boom going on. So there was a lot of labor probably helping build those homes. How efficient it was, I don't know. What I will say is, do I want the government to be building homes? Absolutely not. Governments are extremely inefficient. Just look at everything else they do, the delays, how many times it goes over budget. It's bloated garbage. There's no way. I don't want the government building any houses because they won't get done in time. They'll cost too much money. All that. I have no need for that. I think what government needs to do is get out of the way and start letting people build. We've been building one type of house for far too long. We need to start building more density. And one of the big things, like, it's not being talked about enough, is the amount of fees, government taxes from the municipalities that are being applied to these. When COVID happened, fees skyrocketed. People saw how low municipalities saw how low interest rates were. They took advantage of that with all the additional fees that were slapped onto homes. They made them extremely more expensive. Those need to be significantly reduced. But the thing is, do municipalities have the money to pay for everything because they thought these fees would last forever? And I think those are something that needs to get away. Number two, the process time to build a home in this country is insane. Get out of the way. That's what people need, is just government to get out of the way, not get in the way, which I think they're going to do here, unfortunately.
That was very well said. And the development charges on the municipalities, that's a whole other subject that really
And that's
should be
that's
addressed
what I
by
was talking
government.
about, is those development charges.
Yeah.
They've skyrocketed. A lot of places are starting to pull those back now to
Yeah.
try and, because you can't sell a brand new home with those development fees. You might as well go out and buy a a what's the word I'm looking for? Property that's been already built.
Yeah. Resale home.
A resale home where you don't have to pay those fees. There's plenty of them sitting on the market. It's significantly less money to do that.
Yeah, and I think the bigger discussion here with the challenge is going to be is it's going to come back to affordability. Like right now, we have so much supply. There's a ton of active listings out there, but we know from all the government reports, they're saying that in the next 10 years, we're massively going to be dealing with a supply shortage. We're going to be in a real challenge there with the amount of people that we continue and are planning to bring into the country and how we expect our population to move. We don't have enough homes for everybody, which is what the big issue was with our housing prices going up in the first place before COVID, because we've been on this run for a while now. And if we're not accounting for that for the future, like, we need to be making those decisions now so that we have the plan to be building more homes. And
Not only that, we
there.
saw the chart for the new home sales for condos. They're not building condos right now. They're not building as many detached, as many townhomes. They're not building enough properties. This will come to a head in the next 2, 3, 4 years. We will see supply constraints again. Um, and a lot of that has to do with interest rates. A lot of that has to do with um, these development charges. Um, you know, the government just can't get out of its own way. Unfortunately, it
Yeah.
seems.
It was nice to see Vaughn start to roll some of those back. And
Yeah.
an interesting comment there from Haley MacArthur saying 70K fee to the municipality of Meaford before you can even get a shovel into the ground. Yeah, it's just too hard to build, and all of that, of course, gets passed on to the consumer. So there's the other
Yeah.
challenge with affordability. When you're going to go buy these new homes, you're absorbing all of those fees because the builder is definitely not doing that. All right, let's talk about some of the first time home buyer rebates that are out there. Of course, the Ontario land transfer tax, we got a maximum there of 4,000. When we're speaking specifically about Toronto, the municipal land transfer tax, maximum refund $4,475. The new housing rebate, when it comes to GST and HST in Ontario, you can get up 75% of the Ontario portion of HST, which is 8%, capped at 24,000. And our home buyers plan, withdraw up to 60,000 from RSPs tax free, making sure, of course, that you pay that back within 15 years. And the first home savings account, save up to 40,000 tax free for a first home. Always talk
Yeah.
with your lender, your mortgage broker, and your realtor. Make sure that you get down and have um, a detailed conversation about this stuff, verifying everything, and you're good to go. But there are some of those little incentives out there. Matt, I love seeing some of this money back, and ultimately when it comes down to putting down your down payment because of the home buyers plan or your first home savings account, that is super helpful. There is savings to be made there. Um, does it move the needle in terms of where we're at? I don't think it makes a massive difference, but when it comes down to closing costs, every $1,000 makes a big difference to a buyer. So I love all of it.
Yeah.
All right, let's jump into some of our market insights as we take a look at. We're going to start with the 416 and 905, but we're going to go through and break down the different regions and municipalities that we've picked out for you guys today. So, taking a look here, Matt, the big stuff that stood out to me, of course, is the year over year change when we're taking a look at, of course, our 905 and 416. But I was surprised to see such a decline in terms of year over year average price. Sorry, not average price, sales volume, because we've talked about this month after month now. But to see the detached being down 27% across the 416 and 905, it's a lot of sales that have disappeared on a monthly basis.
It
And
has.
the pricing being around that 5 to 6%, that's kind of held true with other stuff that we've been seeing. But the sales volume, the amount of sales disappearing from the market, when we were anticipating at the start of this year that we were going to surpass what 2024 was, we're just in a very different spot.
Well, listen, at the end of the day, when it comes to the prices, we should be doing spring pricing right now, and we're not. We're
Yeah.
basically doing summer pricing in the real estate market right now. So the reason these numbers are as low as they are is because last year, prices were moving to the upside. This is the busiest time of year for people going out and buying homes. That's just not the case right now because of how many people are sitting on the sidelines waiting for some confidence to get back into the market, waiting for the news to say, hey, look, everything's starting to get rosy again. Housing prices are starting to pick up. People are worried about their jobs. People are worried about the tariffs. They got one less worry about the federal government. They kind of know
Yeah.
what that looks like. Still a little bit to go, but there's still just not a lot of confidence in the market. And this is why we're seeing some of these uh, down 7%, down 5%. I think if the tariffs were done with, we wouldn't be seeing these low of numbers.
Yeah. And as we're talking about this, just this specifically the declines that we're used to seeing. This is year over year, but we've been seeing it every month. So year to date, we are down in terms of the sales volume that we should have. We've underperformed in terms of last year's pricing on a month to month basis. Um, I think what we've talked about before, which is worth mentioning now, is that for those of you that are watching the market, and for those of you that are realtors out there, I think there's a strong possibility that we're going to see a repeat of 2020, where we saw things lock down and sales drop during those months, and then we had a really record-breaking summer, which normally we see sales and average price drop off a little bit in the summer. But through 2020, because we missed that spring bracket, it all got pushed into those months. I think there's a good chance that we start to see our June, July, and August outperform last year's in a strong way. I don't think that pricing is necessarily going to start boosting back in any way. We've got so many active listings we've got to see clear off the shelf first. But at the end of the day, I do think that we're going to see sales volume come back into the market during those months. Okay, taking a look at active listings. We are currently sitting at a high. This is, again, across all regions, specifically for condos. The condo market, really, we were feeling this all the way up last year was when it really started to kick in. And we just haven't cleared out of it. It's interesting to see that there was such a good drop there kind of at the end of the year, but everybody came right back on the market, and we're at a new high dating back 15 years in terms of active listings. And of course, active listings does carry that into price, but I want to keep talking here about active listings now for condos in Peel specifically. And again, you can see we're outpacing the last 15 years in terms of our increases there for active listings.
And I just want to highlight one thing with PL. It's up 186% more active listings than what we saw in 2023.
Yeah, huge. And then there's the flip side of it. We're seeing our sales volume being down 28% in comparison to last year. The only time we were lower, again, looking at Peel, was in the months of COVID for 2020 when that lockdown first happened. Waterloo region for our condos as well, we're seeing just that huge increase in terms of active listings, up 100% in comparison to the same time last year. And when we come into termination volume now, Waterloo's, as we've seen those active listings pile up, we're seeing listing terminations. And the reason for that is sellers, even through last year and the year before, in a lot of places have been holding on to previous year's pricing. And so they terminate the listing, put out a new one with a price reduction. And Waterloo's seen a big uptick in that. Really, Matt, that curve is just month over month. When I look at where they were in March to April, a big change there for Waterloo.
Yeah.
Now let's move into York region, specifically talking about the freehold market. And it's interesting because we have seen a slight uptick in median price month over month, which is fantastic. We want to see through the spring market, we want to see that increase. 1.4% is obviously underperforming what we've seen in previous years, especially even last year, which is down 7.2% year over year, because we just had a very different spring. We had no talk of tariffs last year when we were wondering about what was going on with the market. We had a lot less concern in the economy and jobs and how these tariffs might impact people. So I think once that uncertainty starts to dial back, we should start to see this turn around. But I think those year over year numbers, Matt, will be a challenge for at least a couple more months to come.
Yeah.
Really, June, I'd say last year, once we first got our first interest rate cut, the market reacted in an opposite way of what you would have thought at face value. And so I think by June, we'll start to see these balance out in a better way in terms of our year over year numbers. We are seeing a slight uptick in our days on market. Termination volume up as well. Not like we've seen in previous months, Matt. I think people are getting a better sense of where they stand, which is pretty solid. But to see freeholds in York region decline really in terms of sales volume, I know it's like by 6 units, but still to see that come down, it's just not what you're used to seeing. And
not going from March to April.
Yeah.
You should see this, like I said, this is the busiest time of the year. This is when most people want to do transactions to get, move out when the kids are done school and move into the new place, be there for the summer. And so to see a decline in sales from March to April is significant, even if it's only 1%.
Yep, absolutely. And when you think about the amount of times you've been sitting down with a client and they say, I want to wait till after March break, or I want to wait till the gardens are looking good, the snow's melted, I want to wait till I can open the pool. We just see more more sales volume, more inventory hitting the market as we move through the spring. And right now, we've been seeing it in terms of our listing volume. Although I'd say it was a little lateral there from March to April in terms of new listings hitting the market. But we're right in the mix of where we should be historically for new listings. The difference comes when we start talking about our active listings. Not as high as we've ever been, only surpassed there by what, 2021? No,
No, I think it's 2018, 2019.
2018,
The
2019.
last
We're,
time we saw interest rates as high as we've seen them now.
yeah, and recovery years from our 2017 changes. So, yeah, we're right in the mix with those other years where we're coming off of big changes in the market and, like you said, higher interest rates.
Yep.
Here's the one that people are feeling is the lack of sales volume. Right, we're now again the only time we've sold more is then when we were all locked down and couldn't leave our houses. So it's it's a shame to see the sales volume so low when we look back over the last 15 years. Um, and I think that we need some more of that certainty to come back into the market, and hopefully a couple more rate decreases to make affordability just a little bit easier for people. Like I said last year, Matt, we sold more homes at higher interest rates and higher median prices. So affordability has got better, but it's not being reflected in our sales volume yet.
I mean, I can't stress the significance of this chart. Um, the bottom in April, the entire country was basically shut down. People didn't know if they were still going to have a job. People didn't know what was going on. People didn't know how long this was going to last for. And, we're just above those numbers.
Yeah.
It's a significant drop off in sales for an economy that can get out and do things. They're not being told to hunker down at home. So
Yep.
that's just how little confidence in the market right now there is because of the tariffs. I think ultimately maybe there's some affordability in there as well, but I think tariffs are the biggest driver here.
I think so too. And again, looking at that, how all that the sales volume got pushed into our July, August, September, October, where we know that this section right here, these months, typically where we see the most amount of sales happen for the year. We're not seeing that again. Could we see this uptick to a higher number in here? I think that's definitely possible. I don't think it's going to be record breaking like we saw in 2020, but nonetheless, I think we should see a steady increase in sales start to move through. And when we talked there, Matt, about median price, like we said, kind of sticky. We're still above our 2021 and 2020 pricing, but below our previous 3 years in terms of median price for freehold properties in York.
Even for the pricing here, 2023 and 24 were almost the same price you were paying for the average detached property in York region. And we can just see, how little activity there's been to bring that price down to where we've seen in 2021. You know, it's a big gap when you're not selling homes.
Yeah. I think as you look at the later half of the year for 2021, again, we're talking about York Region freehold properties, but this will hold true in a lot of places. We're over 2021 pricing right now. And the reason why we're referencing the years is because think of all the people that bought since 2021 to now. We're going to be coming into a time where if this kind of holds steady, because we're not anticipating any major upticks in terms of average price, we will be then underwater in terms of what 2021 people were purchasing. So there are still going to be more people impacted yet to come at those higher purchase prices, higher interest rates coming up to their renewals soon. And we're going to be coming in at values under what they purchased. So I think as much as we want to be positive, there is still segments of the market that will be feeling more pain in the coming year.
Yep.
Months of inventory up. We're now up to just under 6 months in York Region when looking at freeholds. This has been kind of a steady climb. And I mean, minus the peak, not too dissimilar to what we were talking about there with our 2017 to 2019, both at what we saw there in terms of active listings and, of course, directly carrying through to our months of inventory because our sales volume is so low. And I think that's why we're seeing the peak, because even through those years, we were selling more in the current month than we are now. This is one we talked about a lot, Matt. And for you, those of you that are realtors out there, the multiple offer strategy is something that I think still needs to be discussed. And it's interesting to say that because since the change in 2022, it's been off the it's honestly been off the plate for most people. If you're I guess depending on the place that you are, but when we're looking at the amount of choice that a buyer has and the lack of buyers out there, it just does not make sense to hold an offer date, have buyers compete, hopefully bring that price back up to market value or a little bit above. We've seen a lot of those fail. There was a couple of times through like last spring where we saw there was so little inventory, a lot of buyer demand. It worked out, but we saw a big a big uptick, let's say, coming through the start of this year. And the reason I think that we're seeing that percentage of homes selling above the asking price, or we're seeing that percentage go up, is because there will always be homes that will command that type of demand from the buying pool that's out there. There's always going to be the home that's on the backing onto the ravine, on the quiet court, whatever it may be, in the desirable school district. Those will always command that type of attention, so that strategy can work there. And because we're selling a lot less homes, that percentage is inflated. So it makes sense to me to see that upticking. The other thing, Matt, where I've seen this happen specifically for a home that we were doing a consultation on, there was a home listed at $899 for a month, didn't sell. They reduced the price to $800,000, $799, and they sold for $875. Now, when you look at that, it makes no sense. At $899, why did somebody not bring that person a buyer for $875? You can easily negotiate that. Why I think it worked for them is they created urgency in a market that has no urgency,
Yeah.
for to speak in general terms. So I do
Yeah.
think that there's elements where you have to take a look at that option.
I'm working with clients who are looking to buy a fixer upper, put some TLC into, and a lot of the homes that we're going to see are having offer dates on them because they don't want people just sitting on the sidelines and watching the some of the nicer homes in the area sell, and maybe they're reducing their prices to sell. They're trying to bring people off the sidelines right away, show the value. And to be honest with you, I think we've looked at three places that were holding offers, and all of them got three or more offers on the property. They're not selling for above market ask, but they're getting a decent price for the property that they probably would have got in a regular market had they just priced the home at where close to where they wanted it. So it is working for some situations for sure to get people off the sideline and get offers on the property.
Yeah. I think the regular rules still apply. So first, let's be clear that this strategy takes a ton of skill to pull off. Just in general, even in the hot markets, to really capitalize on it, there's a ton of skill that goes along with it in terms of
Yeah.
where you're pricing it, how you're communicating with buyer agents, how you're setting seller expectations, specifically that communication with other agents to set the expectation of where you might be, to bring enough people along so that you have a lot of offers competing, because it's still only going to be maybe your top two, top three that are going to boost that price up. And I think that a lot of people still just get it wrong. They get the pricing wrong, they get the expectations wrong, they pick the wrong house to do it on. And last month, the last few weeks, I've been helping a buyer down in the west end of the city. And we came into a bunch of places that were getting competition, and a lot of them did very well. And funny enough, as of this week, I've had three of them that we had interest in originally all miss their offer dates, not have offers registered. And same thing, our client decided ultimately that it's not the right fit for them. There was too many buts, is what my client liked to share. He's like, I like the house, but where it sits, the street location, the floor plan, whatever it might be. And there's too many buts. People aren't going to come forward. So you need to be mindful of that. But anyways, coming back to this, we saw a big uptick at the beginning of the year, slight rollover, sitting at about 30% of homes are still selling above the asking price, which is interesting to watch. And I think it comes down to how can we help create urgency? If you're representing a seller right now, how can you create urgency among those buyers to take action, help your seller out in the best way possible? Matt, talk to me about highlighting our 2 million here, 2 million plus, and the amount of homes and inventory. When we were putting these charts together, I thought of a story and I want to share it real quick. I had an agent that I just did a deal with, and she's like, by the way, I've got a home for sale in the Mill Pond. It's worth 3.6. It's priced super competitively. It should really move, but we've got nobody, coming forward. I don't know why it hasn't sold yet. In the back of my mind, I'm like, well, it's because it's 3.6. What's the buying pool at 3.6? But you speak to some of our other luxury colleagues, and their products are moving. So it's not to say that that doesn't exist. But where my mindset went was when I started in 2007, the average price was 366,000 on the Toronto Real Estate Board. We're now currently at 1.1, and that's a down number considering where we've been at. Still a 302% increase in average price dating back to 2007. So the amount of luxury homes, there's no doubt we've built a ton of them. In Aurora in particular, we've built a ton of them. But
And ultimately these are chipping away at the average price
yeah,
for detached homes, because a lot of these people are going to have to bring these luxury home prices down a bit to get them off get them off the books if they need to get them sold. And what we've noticed is like homes underneath 2 million are getting around 98% of the asking price, whereas homes over 2 million are only getting 95. So they're taking the discounts. We can see they're on average taking 3% less to get the property off the market as of right now.
yeah. And still seeing that the bulk of the sales are happening from that 1 million to 1.5 range, across those two categories there is where we're seeing the most amount of sales. And funny enough, the most amount of listings is hovering in that 1.25 to 1.5 range. So, well, I mean, other than our 2 million plus, but I want to exclude that because it
Yeah.
is quite a price point. But nonetheless, when you're hovering in this price range, there's a lot of stuff that's moving when we're talking about freeholds in York. All right, condos in York region right now. I'm happy to announce that we did see a slight uptick in median price month over month of 2.3%. The challenge we're still seeing is there are not enough buyers taking almost taking the opportunity of the amount of softening in terms of active listings and choice that they have, but as well as the decline that we saw there in price. We went down 17%, lost 41 units month over month in terms of sales volume for condos. I don't
Yeah,
know
and
what
I
you think
mean,
about that, Matt.
even if we're looking year to date this year compared to year to date last year, we're down almost 7% on the median price.
Yeah.
Sales are down almost 31% there. So there's a significant softening there. And again, there are deals to be, when you have this much inventory out there, I can assure you there are good deals to be had. And even getting price points that you're pulling from the future, because some of the other areas will take their time for prices to come down. But there's some desperate sellers there that could be taking lower prices than what we're seeing now.
Yeah, no doubt. When we're seeing the new listing volume, it tapered off a little bit in our month over month, but even just the amount of homes that are hitting the market is at super high levels.
Yeah, and this
Um,
is this is some of the difference we're seeing from what we saw with detached in York region is the new listings were kind of average historical. It was the active listings because of so little sales that was really driving. Sorry, the active listing side. But
yeah,
here you can just see the flood of new listings hitting the market, and that just compiles with what the next chart shows, which is the active listings and the amount of gap that we're starting to form from where we saw last year.
yeah, no doubt. We're seeing that median sale price. We are still up over 2021, which is fantastic. They did have the condo market didn't see the same uptick, like in terms of massive increases in median price, like we saw in the freehold market. So I think we'll be a little bit more insulated there in terms of that rollover when later on in the year comes. But nonetheless, still holding above 2020 and 2021 pricing, but below our previous 3 years when we take a look at that median price. And again, with sales volume down and new listings hitting record highs, we have a ton of months of inventory well into a buyer's market at the 7 month mark in terms of inventory that we're carrying.
And
Now, I want to
I'll say
reset here. Sorry, go ahead,
I'll
Matt.
say York region months of the months of inventory here outstrip what we saw for Treb overall.
Yeah.
So there's a lot of condos sitting in York region right now.
Yeah, specifically as you mentioned, we're looking at months of inventory, so that absorption rate in terms of who's buying these things. Now, coming into new market and taking a look at the freehold insights, same thing. We saw a slight uptick in median price, which is great to see month over month. Normally in the spring market, we would see this at a bit higher of a rate than 1.7%, but not bad. And most importantly, I think transaction volume going up almost 15%, a couple of units there, which is great. We're seeing median days on market is increasing, though. Big jump from 13 to 20 days on market. And our
It's
termination
actually
volume is
100% year over year for the median days on market.
Yeah, coming down to our year over year. We are still down in terms of our year over year pricing. We're down 3.7%, not as big as some of the other areas that we've seen. And of course, sales volume being down 40%. This is something that we've seen kind of across the board. So it's important to note. And that transaction volume, it's about 40% year to date, which is interesting to see. Prices being down a little bit more when we look at the year to date volume again, because we should be seeing higher numbers here in the springtime. So we're down 4.4% in terms of median price.
Yeah, and I mean new listings, kind of historical averages, maybe a little bit less. So we're not
Yeah,
getting that new listings, which is helping stabilize the prices that we're seeing for detached and new market.
exactly. If we looked at like some of our other charts where we're outpacing new listing history, we wouldn't have that uptick in median price. Even as small as it was, you wouldn't see that. Thankfully, the new listings has been slowing down a little bit. It's been right there in the historical average. Active listings were still high. We're still just under, we're the fourth highest year going back 15 years. And Matt, talk to me about sales volume. We just outpaced the people that were locked in their homes in terms of sales volume.
Just,
Just.
just, and, it's that's pretty significant drop off for new market. We are starting to move to the upside, which is good because even last month was pretty worrisome. Had
Yeah.
we seen that number continue to either fall or stagnate,
Yeah.
but we did come up a little bit from March, so that's a good sign at least.
Yeah, so when we look in previous years, this is what we expect to see increases throughout the spring months in terms of our sales volume going up. When we moved from February to March and we saw that rollover and actually decline sales volume, we got a little nervous about where this was going. Thankfully, it lasted only for a month and it's upticking again. Hopefully, we'll see kind of like this 2020 trend. We see the sales volume really uptick kind of just down the road a little bit more so in our summer months. And again, outpacing 2020 and 2021 in terms of median price. But when we look back at 2021, we see this big increase towards the end of the year. And then, of course, 2022, where they start out. So I think there will be people in this stretch, sorry, I guess these next stretches of years that are going to continue to be under where they purchased.
To be fair, though, where the price is right now relative to the amount of sales that we saw,
Yeah.
um, it's not terrible. This
Yep.
could be a lot worse for new market,
Yep.
but I think it's holding up quite strong compared to the last 2023 and 2024.
Yeah. Yeah. Not far off. Not far off from those 2 years, just in general. Months of inventory quite high. We're sitting at just under 5 months worth of inventory, which again, outpacing everything that we've seen in the last 15 years. As we start to see more sales come back into the market, we'll see that roll over. And I think that we'll start to see a more healthy growth in terms of that median sale price. Taking a look at Aurora, specifically, of course, our freehold market, Aurora in the last couple months, I'd say, had a little challenge, but there is a highlight. I would say March was pretty good month in terms of what the change we've seen here, specifically more so in the detached. But looking at freehold overall, we're up just slightly month over month in terms of median price. We're seeing more sales come back in, which is fantastic. We are down when we look at those year over year numbers, 20% in comparison to some of the 40% numbers we've seen in other places. We are down 40% year to date in terms of that sales volume. Matt, when we talk about median price year over year, this is probably the most drastic number we've seen. And I think it's mostly because Aurora has such a wide range of housing that even when you're looking at median prices as opposed to average prices, you just can't account for the fluctuation when a couple of those big homes sell. Because I don't think that the market accurately feels like you're down 12%, or 13% year over year. Down for sure, like 6 to 5 in a lot of the neighborhoods that I specifically look at. but 13% definitely feels big.
I would argue that Aurora has a lot of those high end over $2 million homes, and that's where we're starting to see the significant pile up of inventory is in that price range. So maybe we're starting to see a little bit of fluctuation there. But I was just looking at the chart for prices compared to the last 2 years, and
Mhm.
it's held up not bad. Why are we seeing 1430 or 1.43?
Yeah. Like I honestly, I think it is just because when you have a couple of those months where a few of the really big homes sell, it definitely messes with the numbers a little bit.
Yeah,
It's not a huge town, but it has a very wide scale in terms of pricing. So I think that those median numbers can be toyed with a little bit. And when I look specifically at um, when I look specifically at the median sale price for the detached housing, now we're looking at everything across the board here, detached, semis, and the towns in terms of our freeholds. But when I look specifically at detached, the swings are really big on a month to month basis, like $300,000 swings in terms of median price. And so to me, that just says a couple big homes sold one month and not so much on the next month coming through. Let's backtrack here to our new listings. We're right in the middle where we should be. We're seeing people slow down in the spring month in terms of listing, whereas we're usually seeing this uptick. There's a couple where we go a little bit more laterally from March to April, but nonetheless, when we come over to active listings, because the sales volume is down, we're at the third highest year for buyer choice, let's call it. And we've now surpassed what we saw there in 2020, which is fantastic because here's the other thing you got to remember, Matt. Look at the start of the year. We were selling less homes in the start of the year than we sold when we were locked down. Couldn't leave your house for the first time in history, like our modern history. I'm sure there's maybe another time something happened, but in our modern history, you were told not to leave your house, and everybody was out of work. We sold more homes there than we did in January, February, and March when we talk about freeholds in Aurora. So we've got a lot of work to do here in terms of bringing buyers back into the market. Median sale price. Now, here for the freehold, in comparison to what we were looking at in Newmarket, we're deviating further from what 2023 and 2024, where we've got a bigger gap there to where we currently sit. And we're only just hovering over 2021, where we dipped down last month. And I think a lot of that, because again, I've been watching the detached market, I think a lot of that is being felt in the semis and towns, is where we're seeing a bigger challenge, which is interesting of all places. But nonetheless, that's what the numbers say. And we saw a nice decline there in terms of our months of inventory, Matt, because we saw less new homes hitting the market. So it's nice to see we're moving back towards more balance as opposed to our sellers market there, or sorry, buyers market. And here you go, looking at the detached. Here's the big change. I'm talking about these swings. Look at how this moves when we're looking at sale price. Like these are big numbers when we're jumping between 1.5 and 1.4 and high 1.3s, because we're now finishing in where we are currently in April at 1.36, where we were up well over 1.5. I think it was actually 1.6 something for the month of March. So big swings when you look at the detached.
yeah, it's interesting with the prices rolling over and the sales volume actually increasing. We showed this chart last month because we had a big swing to the upside with a flat lining in the sales, but now we've seen sales pick up and the prices start to roll over a bit. So either
Yeah.
uh, you know cheaper homes or more people are buying just the more affordable homes in Aurora right now.
Yeah, I think that's what we're seeing in terms of our month over month basis, because the swings are they're just too big, right? They're just
Yeah.
too big. Aurora has that on a monthly basis. All right, Matt, I want to throw Georgina over to you. Talk to me about the freehold market that we're seeing there right now.
Yeah, so a lot. Most places are a lot very close to the same when we're looking at the data. Price is up 1.1% month over month, but down 5.7% year over year. If we look at the transaction volume, actually, we did see a decrease of 16.7% month over month, whereas a
Mhm.
lot of other places we've been looking at, there's been an increase on the transaction volume. and 33.3% decrease in sales year over year. When it comes to new listings, up 15.2%. Median days on market went from 15 to 19 days month over month. And termination volume decreased by 4.1%, which is good to see. A lot of other places we're still upticking a little bit. So having them come down 4.1, they're getting closer to being properly priced.
Yeah. And when we take a look at new listings, like a lot of other areas, it seems like people just kind of paused for a second. You know, we're right in the thick of it in terms of what we've seen in past years. Maybe a little bit high because there's only 4 years really above us in terms of that new listing activity. It's funny to see, look at the amount of new listings that we're hitting in 2017, really straight from March all the way through to March to May, those 3 months. Just such highs in terms of new listing activity coming out in 2017.
Well, I find like Georgina, Simcoe, when the market does their pullbacks, they're usually hit the hardest first. And definitely in 2017, we could, like you said, we saw a massive pullback in the market on, or a
Yeah.
massive upshoot with new listings on the market as people realized prices were starting to roll over.
Yep. Yeah, absolutely. Active listings, a spot where we're not at our highest, but still only two above us previously for the month of April. So lots of choice out there for buyers. Sales volume, just above. I don't know why I keep using 2020 as our reference point, but we sold more homes than we did in April of 2020, which is fantastic. But we are still low. So we're hoping to see this push through into more maybe our summer months, and it's interesting to see just the fluctuations that we've really seen here in Georgina in comparison to other areas,
Actually, Dylan,
on what that looks like.
unfortunately, the 2020 line is almost invisible. So we are a little bit above 2020 in terms of
Yeah,
sales. It's just unfortunate that 2020 was pink. And because we wanted to highlight this line, it kind of went invisible there. But we're very close to where we were 2020
we're
for
very
sales.
close. Yeah, above it, but close, because that's 26 units to our 40 units this year.
Yeah.
So it's interesting to see. But again, not it's funny looking through
Oh,
this. There's more of a push later in the month. It's or later in the year, just slightly by like 1 or 2 months in terms of Georgina in comparison to the general trends.
yeah.
Now, when we do take a look at median price, we've just dropped down to below, and the second month in a row now, really, where we've dropped below our 2021 pricing. So the last 4 years have kind of outpaced where we are currently. So I don't know if we're necessarily seeing the exact same amount of stickiness in terms of that pricing here in Georgina. I think they just made their corrections earlier, if that makes
Yeah,
sense.
I think so.
Yeah. Coming through to months of inventory, not record highs. We're down at our third peak, but very high in comparison to some of the other areas. We're sitting at 7 months worth of inventory. Very much a buyer's market there in Georgina, which just means lots of options. We should see those sale numbers increase as people take advantage of that and take advantage of
Yeah.
the buying power that they have. All right, Matt, talk to me about what's happening here in Simcoe, specifically in the
Simcoe.
freehold market.
Yeah. So prices down almost 2% month over month, down 4.7% year over year. We did see a nice increase in transaction volume month over month, up 21.5%, but that's still down almost 29% year over year
Yeah.
for transactions in Simcoe. Um, Now, new listings volume year over year is actually down 12.3%, which tells me, they had more of a push for properties hitting the market last year than they are
Mhm.
this year. So maybe they've already experienced some of that mass push onto the market for the new listing side. And then median days on market, we've stayed the same. I don't know why it's 2.1%, but it's still 24 days month over month. But we are up 4 days year over year for the median days on market. And then termination volume up 14.1% month over month.
Yeah.
And we can see on this chart, like new listings, you would think that this is actually the sales chart for
You
most other
would.
places. But no, for Simcoe, the new listings, this is the second lowest year for new listings we've had since 2011. So that's a good sign that maybe, like I said, the bulk's already been put on the market.
And we're seeing
And
that
active
translate over to
listings,
actives. Yeah.
yep, actives in the middle, which is good. But then we come over to the sales volume. We're Simcoe is not immune to what's going on, unfortunately. But what I like about Simcoe is that at the end of the day, if prices start to accelerate to the upside because tariffs, the confidence in the market comes back, Simcoe's positioned quite well. They don't have this insane abundance of properties that are sitting on the market as compared to a lot of other places.
Mhm.
So if that price starts to accelerate and sales start to accelerate, uh, it's going to eat a lot of what's sitting on the market up, and we could see some better upwards pricing pressure than some of the other areas that we're looking at.
Yeah, like you said, it's come down. We're not talking about 7 months worth of inventory. It's 5.6. So very
It
different
looks like
spot than
they've
even just
topped out.
constructed.
I
Yeah.
think they've topped out on inventory. I think prices have gotten to a point where they're more desirable in that area,
Yeah.
and, yeah, like even when you looked at the prices, it's very tight. We're almost
Yeah.
right there with the last couple of years. So um, I can
Yeah.
see this maybe following the 2021 path and starting to accelerate to the upside later this year.
Yeah. Yeah, I agree. And it definitely the tightest we've seen in terms of the last 3 years. Like this is the stickiness in pricing that we talked about when we were looking at one of our general charts.
Yeah.
Simcoe is very much showing that right now. Taking a look at the above list price percentage of sales. What are we looking at? So below,
I think
what's
we're
this number here?
13%.
13%.
Yeah.
Yeah, 13% for our ones that are above the asking price there. So yeah, we're not seeing multiple offers really pan out so much up
No,
there.
and we haven't really seen them there over the last couple of years. The spring
Yeah,
market for 23 was 29%. Then it went to 20% in 2024. Now 13% now. So that strategy out in Simcoe is much less used than what we see in
yeah.
York region.
In York, because even York was currently hovering around that 30% mark, which is what we're seeing back in 2023 for Simcoe. So yeah,
Yeah.
very very different market in terms of how they handle that. Now, Matt, roll into me here for Barrie. Talk to me about what's going on in Barrie, specifically in our freehold market.
Yeah, I mean the numbers are a lot similar to kind of Georgina as well. Prices down 1.4% month over month, but only 2.9% year over year, which is significantly less than what we've seen in a lot of other areas that are sitting in the 4, 5, 6, 7 range. So year over year holding up much better. Transaction volume increasing 5.3 month over month, but still down 18.1% year over year. But again, not as significant in a lot of other areas that we've seen. New listings volume up 14.9%, but month over month, but year over year only actually down 5.1%, kind of the similar of what we were seeing in the Georgina area. And then
Mm.
median days on market went from 18 to 23 days month over month and 14 to 23 days year over year.
Yeah, so just slight upticks there. New listing volume, again, coming in way less than a lot of the other areas that we've seen in terms of their comparison going back 15 years.
And almost in half from what we were seeing,
Yeah.
in 2017 when it was at 944. I would say the average is probably in the 650 to 700
Yep.
range.
Yep.
So quite a fair bit of less homes
Yeah.
hitting the market than what we've seen in years past.
Yeah. And again, a surprise active listings right in the thick of it, not outpacing the rest.
Yep. Back at 2015 type levels.
Yeah. Okay. Sales volume. Here's where we continue to hold up our trend.
And it's just a
Just
flat
coming in,
line.
it's just a flat line. That's where the sales volume is at across the board right now, underperforming the last 15 years. So when you see those year over year numbers, don't be surprised because you could use almost any year in the last 15 years and you'd get a similar
Yep.
number there in terms of
And
how
this one is
sales
actually
volume performing.
legitimately lower than what we saw in 2020 for
Yeah,
sales
yeah,
during the pandemic.
yeah.
Crazy.
Uh, but again, seeing that stickiness in terms of the median price.
Yeah, this
There's
is a
no
very
one.
tight range for
Yeah,
prices. So
yeah,
it's holding up significantly well.
yeah. Yeah, for example, we're looking at 749 right now in comparison to 771 and 775 the last 2 years, and surpassing those 2021 levels that were at 729 for median price. Months of inventory lower than a lot of the other areas. Again, coming in at 4 months, very balanced.
I think that's the tightest market we've covered today
Yeah, I think so as well.
for freehold.
Now, I don't think that the Simcoe condo market is going to tell the same story, but let's take a look, Matt. Talk to me about that nice little bump we saw in median price.
Yeah, so we did see a 3.1% increase month over month. Now there's significantly less sales here with only 57 sales in April compared to 67 the month prior. So that was down 15%. It's down 37.4% year over year, which is what we were expecting there. New listings actually down 1.7% and down month over month and down 12.1% year over year. So some of the other condo markets, we're not seeing a year over year decrease in new listing volumes. And then when we're looking at days on market, we actually went from 40 to 33. And then the termination volume up 21.4% month over month, 32.2% year over year.
Yeah. And again, looking at that new listing, slightly decrease on the month over month basis, but still high for what they typically see in their condo market. Active listings, again, we're talking about a condo market. Not surprising to see it at the highest levels we've seen. Still hovering just a bit over there. I guess it would be what 2024's numbers really at
Yeah,
563.
yeah.
So interesting to see sales volume kind of at the bottom, just outpacing our 2020. Really, I'm assuming it's our 2020 numbers because that's 48. Yeah. Yep.
But also
57 to
rolling over
48.
from March.
Also rolling over, decline from March to April. And when we take a look at the median price below our 2021 pricing, I would say
Yeah,
that, you know, we're close to that, but we're down significantly enough from the previous 3 years that we've experienced
yeah,
that.
definitely not as sticky with the prices
No.
as detached in Simcoe.
Yep. Agreed. Agreed. Months of inventory all time high. Well, maybe not all
10
time high. Interesting enough. Look at. We got to go back and explore this at some point. But
I
2011's
know.
months of
Unfortunately,
inventory.
these charts only go back as far as 2011, but
Yeah.
we'll have to pull up some numbers
Is
from another source to
evaluate
get
some
it.
other market watch numbers.
Yeah,
I'm really curious to see what this is in comparison to other condo markets at the time because we've not seen that at all. But the big thing here is not just that we're at like a new peak here, but we're really just under 11 months worth of inventory for the condo market. So if you're a seller there, you really got to stand out, and you got to stand out in pricing. Unfortunately, it's just what's
yeah.
going to move the needle there. You've got so much competition. All right, Matt, talk to me about a little bit about our leasing report, specifically in York, as we talk about what some of our investors may be seeing and what's
Yeah.
happening in the rental markets.
So I know we talked about the rental market earlier in the program. We were showing that rents were decreasing. Now we're kind of getting into the time of year where we are going to see a little bit of strength as more and more people. This is typically when they're looking to move from one rental to another. So we will see a little bit more activity, and we see that right off the bat. The month over month price is up 1.9% from 2,650 up to 2,700. Transaction volume up 7.2% month over month, and also 12.7%
Mm-hmm.
year over year. So we're having a much stronger month for rental leases than we did see last year. When it comes to new listings, up 3.6% month over month and 33.7% year over year. So we are seeing a decent influx of new listings as well. Days on market, month over month, it's been steady at 20 days. Last year was around 18 days for the property to lease. And then when we're looking at termination volumes actually came down 2%. So they're starting to find a range for the rental prices. But year over year, we still are up around 50%, 50% more termination volume than what we saw last year.
Yeah. And despite the seasonal change, like you said, year over year, we're still seeing a slight decline there in terms of our median price for what these rentals are going for. So it makes sense that we're seeing that benefit from the supply. And when you look at the amount of new listings, like you said, we're at really high levels. There's a lot more people putting those properties up for rent at the end of the
Seeing
day.
a lot more properties come for rent. I think that trend will continue. I think we are getting, that little bit sharper influx of people renting right now. That will calm down in the next couple of months, and we will probably start to see, because of these high new listings and potentially and the active listings when we go to the next chart,
Yep.
just how much there is sitting on the market, that it will ultimately start to bring those prices down a little bit more as renters have more choices.
I mean, take a look at this. We've got around 2,500 units available for rent, and the bulk of our previous years are hovering at 1,000 or below. So it's just a tremendous increase in the availability of units in comparison to
Yeah,
where it was
and
before.
I'm also surprised to see in the lease volume, if you go back one, we're having record number of leases. So there's
Mm.
definitely not a massive loss of individuals in the York region area, because we're also seeing 15 or 14-year highs in the
Yeah,
amount of leases happening right now.
yeah. And I think that when you go back to what's been the change and what was one of the big concerns when the interest rates started going up so high, when house prices went up so high, you worry about people that can no longer afford those payments. And when they do sell the house, they don't lose the house. Canada's done a great job of making sure that we don't have a ton of foreclosures and power of sales, the power of sale being what the tool we use here. Um, we don't see those numbers have gone up. There's no doubt they've gone up, but not to the same levels that we see in the U.S. when this stuff happens. But I think what we do see is we see more people move into the rental market when they sell their
Yeah.
home. So that is something that we see when these markets come around.
Yeah, that's a fair point, Dylan. A lot of people would have been buying right now; instead, they're renting, and that's having a huge effect on
Yeah,
that number, 100%.
yeah, no doubt. Months of inventory super tight. Funny enough, we're seeing all these record highs in terms of active listings, new listings, but we're under 2 months worth of inventory in the rental market. So there we go. We talk about that demand. This chart here is why there's still so little out there available at the end of the day. Like there's a lot available, but it's getting picked up and it's moving quite quickly. So we really only have
Yeah,
2 months worth of inventory in that rental market.
yeah,
So that was talking about York. Let's take a look at Simcoe for those same numbers, Matt.
yeah. So Simcoe month over month up 2%, and year over year up 2% as well. So seeing some strength out in Simcoe with the prices. Transaction volume only down 0.6% month over month, but we are seeing a little bit more steeper year over year at
Yeah,
21.1% down. New listings month over month up 7%, but again, down 12% year over year on the new listing side. And
yeah,
then median days on market going from 25 days to find a tenant to just 21 month over
yeah,
month. And year over year, down 12.5%, going from 24 days to 21 days. And actually, termination volumes falling off a cliff. In most areas that we're looking at, these numbers aren't as low. So prices definitely finding their range in Simcoe right now.
yeah, yeah, absolutely. So we're seeing that uptick there in new listing volume. Not tremendous, but still third highest in among previous years. Whereas in a lot of other cases, we were seeing kind of middle of the road in terms of new listings, but not so much in the rental market when we're coming up here to Simcoe. And you got active listings. Matt, talk to me about the active listings.
Yeah, active listings lower than what we're seeing in York region. We've had, I believe it's 2023 and 2023 and 2024, where we had a lot of active listings in the 700s. When we go back and look in history, we're looking at typically 97, 120, maybe some in the 200s.
Yeah,
These are very high active listings for the Simcoe area. A lot of investors went out to the Simcoe area because of the price points on the properties, and wanted uh, to own some rental properties out there. So that's why I think definitely over the last couple of years, we've seen so many more rental properties and active
yeah,
listings hit the market.
yeah. Makes sense. Lease volume still fairly high. Third highest year dating back to 2011. So again, just a strong rental market out there. Pricing
But that's
staying
the
very
thing,
sticky.
is that the renters were out there, and they
Yeah,
were they were moving out to Barrie as well for the affordability.
Yeah.
And when you look at the price, the median lease price, it's very tight, very sticky there.
Yeah.
We're seeing it almost just under where we saw the price in 2022.
Yep. And then months of inventory, not too dissimilar to what we were looking at
Yeah.
previously in York, but just 2 months, 2.06 months worth of inventory when we're looking at the rental market there. So inventory coming up and getting scooped up as well at the same time.
Yeah.
Beautiful. All right, everybody. Well, thank you so much for sticking with us through that show. I want you to know that we do break this video down into specific regions. There will be a long video with timestamps. So if you tuned in to join us at the beginning, I don't know why you'd be seeing this message now if you've already left, but just so you guys know that are watching, you can go back with the timestamps to get your specific section of the video that you're looking for. Matt, anything else we want people to know in regards
Yeah.
to when they can access this content and where?
Yeah, absolutely. It'll be on our YouTube page, Economics of Real Estate. You can scan the QR code. I also chop all these videos up per, like if you're looking for just Newmarket, just Aurora, just Simcoe,
Mm-hmm.
there will be standalone videos on these areas so that you can just watch that area. If we haven't covered a certain area that you want more information on, that you want us to see, you want to see some charts and some data on, just let us know. If there's any economic data that you would like to know more about or see in our videos, let us know about that as well, because that's definitely something we would add.
Mm-hmm. For sure. We left Richmond Hill out today because the slide deck was just getting way too long. I want to do one for Richmond Hill, so that will be up on the channels shortly as well. And again, thank you so much for joining us. We hope you benefit from this. Our goal is that you walk away more educated, and whether if you're an agent, we hope that you can better articulate this information to your clients so you guys can be giving great advice, making sure that buyers and sellers are both out there able to take advantage of opportunities when they see them, but also help to insulate them from the challenges of the market that we're seeing. And if you're a homeowner, again, our goal is just to make sure that you are super informed about what's going on in the area to help you make more decisions, more smart decisions. And otherwise, we do this video at the beginning of every month. Look forward to seeing you again next month. But we do on our YouTube channel do other videos, supplementary videos talking about policy, talking about specific neighborhoods. So please check us out. Look forward to seeing you again next time. Thank you so much, and bye for now.
Take care, guys.